Okay, because given that it's a Saturday, it's unlikely that everybody's going to show up, but we do have most everyone here, I guess. All right, so what I would like to do with these weekly webinars is pretty much a Q&A kind of a thing with you for anything that you're having trouble with the XRV setups, and to just go through it with you and show you kind of how we're dealing with those setups, since they're a little bit different, right, than the fastball on the trading plan. Right, it's got a very different kind of a way that it plays out over the course of, from being set up through actually trading it. So let me just share my screen, and what I'm going to do first is just show you, just go through this one more time about how we select these. Hold on a second. Okay, so here I just went back to right before Christmas and pulled up one of the lists that I had come up with, and I think this was for the 22nd, right? We had a good week with these again this past week, but sort of, after Christmas through New Year's is always kind of a strange time to trade, and then they've had such bad weather in New York that pretty much yesterday was like a no-show, right, for the markets. It was that kind of a day. But looking back, right, you can see this was on December 21st, right, and here was the list that we had put up of setups. Now, the reason that I don't have on the site an entry, a stop, and a target is that most of you, first off, who are doing this have been to boot camp, and I thought this was a good opportunity for you to set these up on your own and not have everybody trying to pile in at the same prices and get in and out at the same prices. But I am getting quite a few questions about, where do I get in, where do I get out? So let's go through them and just take a look at why I'm doing these the way that I'm doing them. So the basic setup is the same as the traditional fastball setup, the expansion range and volume setup. All right, we're looking for the widest range of the past 10 sessions. I want to see it happen on significant volume. What's different about these is, number one, they include NASDAQ, and we are going through the entire market, so I'm scanning about 8,000 stocks when I'm looking for these, versus the 1,000 that we do for the Around the Horn plan. And then the criteria that I'm using are a little bit different. So when I had this piece of software built to look for these, what it's doing is actually going through and finding not only the stocks that have this, telltale fastball pattern where you get the expansion move, but it's also going through and looking to make sure that the move is institutionally driven. It's going through and matching up order flow, and then it's also figuring out what the order sizes are, going through, looking at the tape over the course of the day, analyzing how many block trades are going off, looking for the telltale signs that we're going to get follow through the following day. So it's something that wasn't really able to do with flipping through the charts and just eyeballing these, but by using the software that goes through and analyzes this stuff, it makes things a lot easier. So it takes the software about 2 hours to run through these. That's why they wind up being ready about the same time as the trading plan that goes out every day. The other thing that happens here is on any given day, right, we wind up with about, there'll be about 20 that the software generates, and then I just go through and hand pick them then to try to get that list narrowed down to the ones that have the highest probability of going the following session. That part of it I do just the way that you learned to do it at the boot camp, right? So everything that I'm doing manually, there's no secret there. It's just exactly the way we've always done stuff. So once you've got the list that you get every day on the site, right? Of course, at Trader Insight, what you're getting is see here if we can. We're having an internet issue this morning, so. So when you're looking at the list of these, this was the list for Friday, of course, there wasn't much there, right? There's only 2. What I'm expecting that you're doing is just seeing which stock it is, what the symbol is, what the pattern looks like, and then you're going through and just sort of looking at where's this thing likely to go and where am I going to get into it, right? And when I go and set these up, I'm setting some wider stops than we're usually setting on things. So in this case, right, CDEV, this one has a 1993 peak, so we're going to look to get in above that 1993 peak. And, you know, I'm going for deep support and resistance on my exit. So 1963, I mean, you know, if you want to be tighter on it and go 1978, you could do that, but just know that I'm letting them swing a little bit wider than we would usually let things swing. So here, you know, you've got a 5096 level, and then you've got this 5127 level that I'm looking at as stops on this. MTDR, you know, Reese is going to want to put his stop up here. I'm going to say you want to put your stop more like down here. PE, right, same thing, a little bit wider, tends to make for the better stop on these things. And the following session, I'm not using necessarily a 10-cent criteria as the entry price. So I'm sure you've seen in the first hour trading pit that you know, part of what I've been doing is I'll get in with a 4 cent or with a 5 cent or sometimes 3 cents. It's just, I'm trying to do it a little bit on the random side, again, so that we're not all piling in at exactly the same price. So the way that I structure these orders for the following session is very consistent. What I tell the software is we have to be trading at or below this high for a long in order for an order to go live. So if I was going to enter this trade in RSPP for Monday's trading, what I would say is I'm going to put together a conditional order. If the last price is less than or equal to $39.99, then buy stop limit, and I would be buying above that $39.99 level somewhere. So I'd probably go, in the case of a $30 stock, I'm probably going, you know, about a nickel above gets me in. And then in terms of what I'm targeting, my first target is going to be at or around a pivot line. So I always want to be just a little bit shy of a pivot line. So I get taken out on the way to the pivot as opposed to, you know, waiting for the pivot to hit. But in each one of these cases here, I'm not setting those targets as hard targets until the next morning. Now you can, if you want to automate them, then you can certainly just sit down and you know, generally speaking, we're pulling on the $19, $20 stocks, we're getting 30 to 40 cents a share. On the $50 stocks, we're pulling about 50 cents per share, and on the $60 and $70 stocks, we've managed to pull about $1 a share out of those quite frequently. So those are just sort of guidelines on how to set the targets. But now let's look at the 22nd here. Right, so here you can see what I'm talking about. So if we get in with the rules that we just established, right, you're getting in above the high of the prior session. So on LNG, in this example, right, we're going to say we have to trade at or below 51.83. So that's the prior session's high tick. So we want to make sure we're down below that so that we're not getting taken in as price falls down through it. We want to make sure we start on the right side of the trade. So price has to come up to 51.83. When it gets to 51.83, then we have an order that goes live. So now buy stop limit 51.83 or 51.84 is the stop, and our limit price is going to be 51.89. Right, so now you got about a nickel of wiggle in there. That's going to get us in. So just above that 51.83 point is where the order goes live, and then you can set up your bracket as far as how much slip you're going to take or how many pennies of confirmation you want on the way in. And in this case, right, it gets you right up to that 52.62 pivot, and goes on. If you're trading this manually, if you're following the position manually, then you can ratchet up. And if you're automating it, you should wind up getting taken out of this at about 52, 55, 52, somewhere between 55 and 60, and not waiting for the exact level of the pivot. But if we go through these, right, I think the most important thing to do sort of daily is to go through these and look at where you were placing your stops and making sure that you're giving them enough room to move. Right, so look here on MTDR, right, it opens. You don't want to get clipped on this because you set a stop at $29.89. You want to give this enough room so that it's going to move back into the range that you established going into the prior close, and that gives you then enough momentum that you're able to stay with the trade as it starts ticking up. These have a much higher probability of following through and hitting a target than the other trades do. So if you look at these over time, we've been working with them since the beginning of 2017, and giving them room is almost always the best way to trade them. Right? We wind up with really, really good results if we have wider stops and we get taken out of a lot of trades only to watch them go on to the profit target when we set the stops really tight. So on this one again, right, you would set this order up. $30.05 was the high of the prior session. So we want to make sure that price is trading at or below 30.05 on the open. So if it starts up here somewhere, first it has to come down through, and then once you're down through 30.05 and come back up through it, your order goes live. You get filled. Now I don't know if you get filled. This depends on how you're setting that order spread up the first time around. If you used a nickel, then it just barely missed you. If you used a dime, you didn't get taken in until the fourth bar. Or if you used just a couple pennies to get you in, then you were in right off the opening bell, and you got taken down to about 30 cents against you, and then it came up, and again 30.10 up to that pivot. Really just a clean, easy trade, right? And this is the way these tend to play out. So again, here was my stop on PE. Here's my entry criteria. Price started above my price. So when it came back down through, at this point my order goes live, comes back up, fills me, wiggles down again, and then 29.32 to 29.73. Pivot, also about 50 cents, right? So you can set those either way. Here's another one. This is RSPP, right? 38.99 got you in, or a tick above 38.99. A little bit of a swing down, never got close to that stop, and then moves up to the pivot line, and about 60 cents on that one. So that's how I'm setting these up. I mean, it's a lot looser than, this is much more similar to the way that we traded these 20 years ago. So if you have the very first edition of Around the Horn, right, where we used to talk about how we were, or tricks of the trade, or one of those things that we did early on, then you saw us say, well, we're going to get in and we're going to risk 1 point, and at the end of the day we're going to see see where we are. This is much more similar to that than it is to, this really, really structured NYSE stuff, because it's very hard with the, when you throw the NASDAQ stuff into the mix to anticipate every little nuance the way that you can with the NYSE, right? So when we do the New York Stock Exchange stuff with the around the horn trading plan, that's based on, we're looking at what the specialist is doing on the other side of that trade. This is a bunch of market makers running these stocks, and really what we're looking for is on the setup day, where's the order flow? Is the order flow matched to one or two market makers? And then, the following session, are we going to expect to see that order flow continue based on what was going on into the close? How many block trades are going on? Who's placing the blocks? And then, the following session, we're just looking for the first place the price is going to inflect. So again, you can use pivot lines. You can use, 50 cents for the lower dollar stocks, and 70, 80 cents for the higher dollar stocks. Pivot line is kind of the easiest thing to do, or on, in the case of, if you're going to sit there and you're going to watch these things, the pivot lines are also nice, because what you can interject that we didn't talk about here at all is when you get halfway from, where you're getting in to your pivot, you can ratchet that stop loss up from underneath just the same way as you do on the regular trades. But there too, that's kind of an optional strategy, because we've got so many of these things going on most mornings that we just let them run, and we've got the orders out there and we just let them take care of themselves on our end, at least. But that's how I've been handling these. I'd love to know what questions you guys have. Yeah, I mean, the machine is picking these apart, Reese, in a way that you or I couldn't possibly analyze it. I mean, you couldn't get that into what's going on. Yeah, I turned off the screen, Ken, so that I could see your guys' questions. I can't bring up the Q&A unless I eliminate the software there. But yeah, it's going through and it's analyzing the order flow. And when I had this opportunity to work with these programmers, it's nice, because it takes something that if you tried to do it manually would take you a couple days to go through and do, and it goes and analyzes the markets in these stocks and figures out exactly what's going on behind the scenes, so that we're not trying to paint a picture of what we think is happening. We're taking a look at what's actually happening and also seeing the sources of the order. Right, so it gives us a good idea that they're going to be back again tomorrow. If we see that the same buyer is in constantly, then we have good reason to believe it'll happen again the next day. It doesn't have to be a retracement so much as it has to trade at that price. So if it starts above on a long, it has to come back down to the high. If it starts below and just trades up through that high, then we'll take it a few pennies above. So it's not the normal 10 cents. I want to see it trade up and through there, going in the right direction. And then if it starts, the other thing I should say is, if it starts way down and it's a long, let's say it starts way down inside the range of the prior session, then I cancel those trades. And Ian, you could use the volume weighted average price. So you could do, one of the things that I was looking at was, hang on a second. When you're setting your stops, you can take the volume weighted average price of the last leg of a move. Right, so in this case, this would get you up into this range, right? And I guess the last leg of the move really is from here up to here. So, all right, so what we're doing is just sort of eyeballing where the volume weighted average price is. So I'm a little bit, richer on the stop at 39.57. But if you go through these one after the other, that's certainly a strategy that I always like for, establishing your acceptable stops. All right, look at that. I mean, they line up almost exactly with, you'd almost think I've been doing this for a while, right? See, in this case, the VWAP gets you out. Well, I guess you didn't really get in until the next bar, but if you were in, this VWAP would have taken you out unless you're... But generally speaking, yeah, you can use you just have to find the peaks of those major moves. But I just like going through and, popping a line on there and making sure that I've got enough room for just the normal wiggle that the stock's doing. And then what you have to be careful about is when you're looking at the chart, you don't want to look and say, well, I want to make my stop 10 or 15 cents, right, and stick my toe in the water, because these will pop around a lot more than the NYSE stocks do. So you need to make sure, you just absolutely have to make sure that you give it enough of a swing. So David, if we get a big gap in the markets, I will definitely tend to stay away from, I just kind of stay away from them in general. If we're going to get, that's a very good point. If we get a move on an open, where fair value says that we should be opening down 5 points and we wind up gapping down 100 points or 120 points, like we did a couple times in December, late December, right, then I just take them off the table. So if it's a big gap day, I'm not doing the trades on these. I just go through and start canceling before the open. Ian, yeah, you can use the same money management. The thing that I don't do is the 10 cent to target on these. So if I get in and I start making a move towards the profit target, once I get about halfway to that target, usually it's a pivot, so it's really easy to spot, then I'll grab the line and pull up and give myself a break-even stop. But other than that, we don't do much as far as trailing in behind. So the around the horn trades, 10 cents to the target, we move the stop up to 50%. In this case, if it starts heading towards a target and it gets 3-4 cents to the target and it looks like it's getting tired, I just go and take it off. So that's why I'm not putting the hard targets up on the site either, right? It's just you're looking for this thing has, over the course of the year, has been pulling anywhere from 10 to 20 points a month just by trading it open. So I think the worst month that we had with it was 10 points for us personally. So, the looser I think you are with this, the easier you're going to find it to work with. Who else? Okay, that's a good question, Mike. So, yeah, I'm leaning pretty much on that first hour. So at the end of the first hour, I'm calling it a day with these, just because I don't feel like sitting there all day. Now, they have, if you've been watching them, they have gone later in the session and they wind up hitting your target. But if you go through and you really look at them every day, you're going to see that 90% of the time, that first hour is really the sweet spot for whether or not they're going to work out. As far as hitting your stop before the entry, I'm not so worried about that as I am on the around the horn trades. What I will do is take a look at that stop and see how hard the violation was. So if it goes and violates my stop by like 2 or 3 cents, I'll just move that stop, to accommodate for where that swing was. But for the most part, if you've been watching these, most of you guys have been on these for a month, right? They just tend to go. They just first thing in the morning, if they trigger an entry, they're off to the races. They either hit your target or stop you out pretty quick. Ratio-wise, since last January, we've been positive 4 days out of 5 with these, so they've been really solid. Ken, I've been putting the trades in before the open, so you can wait. If you look through the setups, what you're going to see is you've got a fairly high probability that you're going to miss some of them. You definitely won't take the swing if you wait 5 minutes, but there's been a lot of these that just trigger right at the opening bell, and then if it takes off without you, then you're gonna mess up the ratio of winners to losers. But you can wait out the volatility if you don't want it. Would you take them at the pivot? You could, William. You could do the pullback entries on these the same way that we do them on the around the horn stocks, where you wait for them to get to a pivot line down below. The criteria changes a little bit, though. I wouldn't be looking for them to hit the target in that case. What I would be anticipating is, let's say it's a long, comes back down, hits the central pivot, bounces, gets me in. Then what I would look for is a target at the prior session's high and just pull it off there. Let me pop this back up again. Young, you can, if you got in here just a little late, you can watch the recording afterwards, and in the recording, what you'll see is I was going through just a list of these and showing everybody how I set the stops on these, and then talking about the targets. So the questions that you had for Julie are addressed a little bit earlier. So if you watch, it's back about 15 minutes or so. You can just pull that up afterwards, and then we'll talk to you as well about the little bit of extra help that you needed getting figuring out how to get these things set up and get you up and running. But in order to see you guys, I have to stop the screen share. There we go. So Greg, I have not been taking second entries on these primarily because I'm automating it. So I've got these things set up where, they get me in and they get me out. And, at some point I'll probably tinker with it to see what would happen with second entries. But since we've been running it this way for a year, I haven't really gone back and messed with it. Okay, so ratcheting stops. and the return that it's doing. Well, let's take a look at both, I guess. Screen share going again. Okay, so if you look through what these have done, now the results for these are not pretty the way that the around the horn stocks are. These are the way that we keep notes on what we're doing over time, right? So this goes back. This is last January, right? And we just log each one of our trades and whether or not it got us in and what our result was on it over the course of the month. Right, last January did 19 points per share, so $19.20 per share. Traded 18.62 in February. Right, so then you just do the math and say, well, if I'm trading 100 shares, right, where would I be for the month? $1,862, right? You just multiply whatever your share size is by that point value. So that's easy enough, right? I mean, in terms of the results, this is a pretty typical looking spreadsheet for this. You know, you wind up with a couple losers, but they're outpaced by the gainers, right? Every month that we look at, we see the same kind of a pattern on this. The key to this thing, I find, is just to get them all, right? You just have to load up all those trades in the morning, and the ones that trigger get you in. That's fantastic. The ones that don't trigger, you know, the bad thing is they tie up your capital because you have those orders sitting out there. But really, if you allocate the orders right, you know, what's great about this thing is that it just has a real nice little diversified portfolio of fastball setups that you're putting together every day. And, you know, month over month, it has been really, really consistent in the numbers that it puts up. In terms of ratcheting stops, I'm trying to think of which one was it this week that it was on Friday, I believe. So right here you have a case with SRCL where it gets you in. Right, and what I'm looking at is where's the high of the prior session, and then, you know, where am I in the trading today, and, you know, where's my logical stop? All right, so your logical stop on this thing is really wide, and you want to get that moved to break even quickly. So in the case of SRCL, right, we were looking for a move up to the 71.95 pivot. So if price had traveled to 50% of that, then immediately we would have moved the stop to break even. As it was, you know, my stop on this one was moved to 70.77 after we started trading into this range. So this is a case where the stop was a little bit too wide, you know, even for me right off the open. But this 70.77 stop, you know, was just a better stop on the session. But in case of a move up to here, then what we wanted to do was get the stop to break even as quick as we could. So in all of these, right, ESRT, obviously this one didn't go, never triggered for us, but if we would have got short, okay, so your criteria here for a short sale $19.69 was the prior session's low, right? So the next session, you want to get shorts down somewhere below probably 65. If it gets 50% of the distance to that first pivot line, then right away I'd be dropping down on the stop loss, even though we would be targeting that next pivot, right? We're not going to move. We're not going to look for a 14-cent target on this. We're looking for a move down the next pivot. But as soon as it starts making its move towards the pivot line, I'm ratcheting the stop down. So it's a little bit different than the straight around the horn method where you're looking at the distance between an entry and a profit target to move it around. I'm using those pivots pretty extensively. I would trade fixed share size on everything, or I do trade fixed share sizes on everything. So, you know, if you can just wrap your head around the trading philosophy behind this, then, you know, most of the guys who are going to work with these trades are going to trade, you know, 100 shares to start of each thing, and then they're going to trade 500 shares as they're moving on, or they trade, you know, somebody might be trading 1,000 shares. But, you know, in my case, with everything that I've got going on here, I trade these. I trade the around the horn plan stocks, and I trade the Baltimore chop in the morning. Right, we trade all those strategies, and we use the same share size on every trade that we place. $70.75 as an initial stop. Let me just take a look. Yeah, see, this is what I was, you know, if you're right down under that closing range there, then you've got, you either have to say you're going to try a second entry if you get one, right? In this case, it didn't trigger one anyways, but, you know, the reality is that you don't want to be right at those lows. You want to be down into the range some. Well, once you get down to here, right, really your best stop is going to be down below this range, down at about $70.38. But getting it to 70.77 pretty quickly was you know, part of the deal. Yes, I mean, yesterday just wasn't a great day to be looking at anything, right, just because of what's going on and the liquidity issues that were happening yesterday. But generally speaking, if you're going to put a stop right below this closing range like this, what you want to do is make sure you're at least getting down and into the next place you think price is going to go. So if you thought price was going to bounce, if it hit these highs, then a good place to rest the stop is just down under those highs, right? And see if you know, if it does bounce, will it keep you in? Versus putting your stop up here, where all that has to happen is it ticks up into the high of this bar, and then it ticks down to the low of that bar, and it's gonna cut you right back out of the trade. So the volume on these tends to be, these are trading anywhere from 500,000 shares up to about 2 or 3 million shares. What I've done is limited the number of people who are going to be on this plan to 30 to avoid having liquidity issues. So it's almost always the case when we're picking these apart that they were going out on heavy order flow, so on very, very heavy accumulation or very heavy markup or markdown, so that there's enough shares there that when we get into the open, you know, people trading 100, 500, or, you know, even 1,000 shares aren't going to affect the ability of everybody else to get in. So I haven't had really any trouble getting filled on these. I know that in some cases, if you set that, if you set the amount of slip that you're willing to accept too tight, then, say you set your entry at $70 and or at $71 and you only allow for a penny of slippage on this, then you're going to have an issue. I don't take the share price into account just because these tend to move about the same magnitude regardless of the price. So what I'm really looking at is the potential for profit. Right? If I'm looking for about 50 cents on a $40 stock or a $70 stock, I just load up the same number of shares when I'm taking the trades. You can do anything. You can, you could allocate a 50% share allocation to a more expensive stock versus a $30 stock or a $20 stock, or you could go heavier on the $20 stock to get a bigger move out of it. It's just, what Ken was saying a second ago about the liquidity on these. You just have to make sure then that you're mindful of watching how many shares you got filled on, right? Because it's pretty easy to, if you're loading up the same share size, let's say for argument you take 300 shares of everything, your order fills, you just know you're in 300 shares and you're done. You want to make sure that if you're changing share sizes based on the price of the equity, that you then are really conscious of whether or not you got filled for the full amount, and that you make sure that you change your orders on the way back out again to make sure that you actually clear out of these so you're not in them overnight. Just making sure I got everybody's questions. So we'll wait a couple minutes for you guys to finish typing and see what else you're curious about. And then in the interim, I'll just tell you, what I like about this compared to some of the other stuff that we do is the way that I just automate this, and it's like a set it and forget it kind of a thing. And I just come back and look at it afterwards to see how we're doing on the fills. Are the fills complete? Did we get a partial anywhere? Make sure that the orders are cleaned up. But in Realtik, what I'm doing is I'm setting those conditional orders up, and then I'm just telling it that if it partialed me on the way in, to make sure that it matches the order size on the way out. Okay, so that's an interesting question that Mike has there. Do you close out all the trades when you're up a set amount? So there is an interesting phenomenon that we've noticed over the year that we've been working with these, and that's that if we're up, let's say there's 4 trades for the day, and we've got our positions out there, and we are up $1 per share across those 4 trades. That tends to be about where we're going to wind up for the day, playing the orders out completely, right? So in other words, if we have 1 trade, or if we have 2 trades on, and those 2 trades are up a sum total of $1 per share, and we close them out randomly, or just say, okay, we're up $1, we're gonna shut down these 2 trades. One's up 30 cents, one's up 70 cents, whatever. That has tended to be the place that we wound up over the course of the day had we gone and taken all of the trades, right? So it's not that that's a rule, it's that just seems to be what happens, which has been kind of odd. So that's what I had mentioned to you was, if you take your money off the table when you have $1 per share, then that usually winds up being about where you're going to be at the end of the day. TradeStation is going to be, so for those of you who are using TradeStation, the only downside to that platform, especially with the new pricing that they've done, so they're giving you great prices now, right? but they're routing everything through their market maker. So if you're using TradeStation, you're probably going to have to set some slightly wider parameters on your stop limit order, and in order to get the complete fill. Yep, I use a stop limit to go in and a stop market on the way out of the trade. Interactive brokers should be good. I mean, Interactive brokers is so Interactive is using, as I recall, they've got 4 primary relationships that they're using to do their trading through. So you should have the ability to, you'll figure out pretty quick if you're getting slipped or if you're getting partials. And again, you know, the trick there is if you're getting partial fills, then if your entry was supposed to be $20.27 and you're bracketing it up so that you get a 2027 trigger and a 28.29 as the worst possible fill that you're willing to take, if you're getting a bunch of partials, then what you can do is just, you know, adjust that spread a little bit and go, you know, 20.27 is your trigger price, and maybe 20.35 is your worst allowable slip. You know, just give it a couple pennies more. I mean, most of the guys have been having really good luck getting fills on these, and you know, I've got 2 people who are trading this through web-based brokers, so through through Ameritrade and through Thinkorswim, and they've been getting fills on these that are as good as the fills that I've been getting with you know, with my direct access brokers. So it's definitely doable with these other platforms. Like I said, TradeStation, you know, you guys know I've had a long love-hate relationship with those guys, and you know what I don't like is that they've gone and essentially made trading free, but you know, they've got to make money somewhere, and the place they're making money is on the executions that they're giving you. Okay, so around the horn, yeah, if you go to, you know, I permissioned you into all that stuff, Young. So if you go to the part of the website where the trading plans come from for the day, so you get that notification each night that says your Around the Horn trading plan has been posted. If instead of just directly downloading it, you go to the website and you go to, let me show you. All right, if you go to your account and you go to the Around the Horn trading plan, the results are posted all the way back to 2006 on the right side here. Now, I see 2018 isn't on the page there. I'll make it a point to get it on there. It is on the Daily Income Trader. Has the link. This just doesn't have the link yet. But if you pull this up, right, you can take any given year and you can pull up the results just by clicking on the spreadsheet. It'll download the results to your computer, and then you can open there we go. You can open the spreadsheet, and then you can go back through and look. So starting in 2006, everything was just listed in points per share, and then in about 2012, I think we started, breaking this down by how many dollars per share something would generate based on different account sizes and different asset allocations. So where you were asking before about trading the same number of shares of everything, that would be what's represented in the points per share each month. All right, so points per share, you're just multiplying how many points per share did something do and then multiplying that by the number of shares traded. Or if you go through and you look at these asset allocation columns, right, what those are showing you is how many shares would you be trading of each one of these stocks based on the price and based on, in this case, you have 4 possible trades for this day, right? 1, 2, 3, 4 trades that are possible. And if you evenly divided your trading resources, your funds between those 4 trades, then how many shares of each one would you be taking in order to have an even asset allocation between these? So, in this case, you'd be trading 195 shares of this one, 268 of this one, 409. You would never take these odd lots, right? But that's the number that it would be. And then it shows you then what the return is in terms of points, in terms of dollars on a $50,000 account, right? If you traded this number of shares of each one of these for each day, then, this is the asset allocation. 1-to-1, that means you don't use any leverage at all in your account. 2-to-1, that's levered up twice. 3-to-1, 4-to-1 for the month, right? So typically, if you're trading intraday in an account, you're always going to be 4-to-1. I tell people all the time, you shouldn't put more money into an account than you actually want to trade, and you should always be trading at 4-to-1. Right, just when you're experimenting with something, you drop your share size down so you get the hang of how to get in and out of the positions. But once you've got it down to where you're making money on your trading, then you want to lever up. Yeah, you know what, David? For some reason, I don't have the. I am missing most of the spreadsheet that has the rest of the year on it isn't on this machine. But I'll do that next weekend, or I will. I'll talk to you during the week in regards to what happened in October, November, December with the XRV setups. And Young, the best thing would be to maybe give Julie a call again, and she can just sort of walk you through the site and how to access the different things that we're talking about, and do it from your account, just to make sure that everything is where you need it to be. Cool. Yeah, we want to make sure that you can use everything, and that it all makes sense to